Sure. Here is a deep summary of the paragraph you shared. I'll explain everything like you're brand new to economics, using plain language, step by step. This is like a kind, expert teacher walking you through slowly and clearly. Full deep summary in very simple words. This chapter is about learning how a simple economy works, like how money moves in a small country, town, or village where people buy things, sell things, work, and earn. It teaches you the basic rules, like what money is, who makes things, who buys them, and how everyone is connected. It's like understanding the game of the economy before you start playing. What's in the chapter? 1. Section 2.1, Main Ideas You Need to Know First. This part teaches the foundation, or building blocks. You will learn some important ideas that you will need again. These ideas might, what is money? What is income? What are goods and services? What is production? Who are households and firms? It's like learning the ABCs before reading words. 2. Section 2.2, the circular flow of income. Here, you learn how money moves in a circle in the economy. Think of the economy like a wheel where money keeps going around. Example of the circle. People work in companies and earn money, income. They spend that money to buy things, like food or clothes. Shops and businesses take that money, use it to pay their workers, and buy more goods. Those workers get paid again, and the money goes around again. This moving money is called the circular flow. It goes around and never stays in one place. 3. Also in section 2.2, 3 ways to measure a country's income. We can find out how much money the whole country makes in 3 different ways, and they all give the same result if done correctly. 1. Product method. Add up the value of all the things made, like wheat, cars, clothes. 2. Expenditure method. Add up all the money people spent to buy those things. 3. Income method. Add up all the money people earned from making and selling those things. Why do we need 3 ways? It's like checking your test score by using a calculator, a spreadsheet, and asking your teacher. 3 ways to be sure the number is right. 4. Section 2.3, different parts of national income. This part breaks the total income of the country into smaller pieces, so we can understand it better. Think of national income like a pizza. Section 2.3 shows the different slices, like money from salaries, money from businesses, money from renting land, money from farming, money from exports. Each slice is one kind of income. 5. Also in section 2.3, price indices and real versus fake progress. This part also teaches how each prices are rising or falling in the economy. These tools are called price indices, and they include GDP deflator, tells how overall prices are changing. CPI, Consumer Price Index, tells how much normal people are paying for things like food, clothes, and rent. WPI, Wholesale Price Index, tells how much prices change for goods sold in big amounts to shops. It also talks about a very important warning. GDP is not everything. Just because a country's GDP total income is big or growing, it doesn't mean that people in that country are happy, healthy, safe, or treated fairly. For example, if all the money goes to a few rich people and many are still poor, then the country might look rich, but most people are not doing well. Final simple message of the chapter. The economy is like a circle where money flows between people, businesses, and government. We can measure how much money the country makes in 3 ways. By what it makes, what people spend, or what people earn. We can break this income into parts and check how prices change over time. But remember, money is not everything. Real progress is not just about income. It's about how well people live. Would you like me to now explain each section, 2.1, 2.2, 2.3, one by one in this deep and simple way? Here is a great, deep, detailed summary of the passage you shared, written in the most simple and clear language, like I'm explaining it to a total beginner or a child. This summary brings together all the key points, explains them gently, and adds extra examples to make every idea come alive. Detailed summary. What makes countries rich or poor? 1. The big question of economics. Economics is the study of how people, companies, and countries use money, resources, and work to live better lives. One of the most important questions in economics is, Why are some countries rich and others poor? This means, why do people in some countries have good homes, schools, hospitals, jobs, and enough food, while in other countries, people struggle to survive? 2. Adam Smith, the father of economics. A man named Adam Smith lived over 200 years ago in Scotland. He was one of the first people to try to answer this big question. He wrote a famous book called An Inquiry into the Nature and Causes of the Wealth of Nations. That just means, let's find out what makes a country wealthy. His ideas helped create the subject we now call economics. 3. Natural resources alone do not make a country rich. Many people think if a lot of natural things like forests or fertile land, it must be rich. But this is not always true. For example, Africa and Latin America are full of natural resources. They have oil, gold, forests, and good farmland. Yet many countries there are poor. People don't always have enough food, jobs, or good homes. On the other hand, countries like Japan, Singapore, or Switzerland have very few natural resources, but they are some of the richest countries in the world. So clearly, natural resources alone are not enough to make a country rich. 4. What really makes a country rich? To become rich, a country needs more than just natural things. It needs to use its resources wisely. Example, use iron to build machines, or use land to grow food that feeds many people. Have a good production system. This means having factories, workers, technology, and skills that turn raw things into useful products. Have good education and smart people. People must learn skills, think clearly, and solve problems. Have good government and laws. If rules are fair, businesses and workers feel safe and grow. Trade with other countries. Countries that make good products can sell them to others and earn more money. 5. You must transform resources even in just owning resources wasn't enough. You had to use them. Example, a forest is just trees. You must cut the trees, turn them into wood, make furniture, and sell it. That's production, and that's what creates wealth. So what matters is not what a country has, but what it does with what it has. 6. Key takeaway. Some countries stay poor, even with many natural resources, because they do not manage them well, or because of bad governments, lack of education, or weak systems. Other countries become rich, even without resources, because they are smart, organized, and productive. Final picture to remember. Think of 2 children. One child has a basket full of fruits, but lets them rot. Another child has just a few ingredients, but turns them into delicious fruit juice and sells it. Which child becomes rich? The second one, because they used their mind and effort, not just what they had. Let me know if you'd like a diagram or if you want me to turn this into a short story or video script. Absolutely. Let's now go even deeper, explaining the heart of the idea behind the comic and passage in a slow, thoughtful, step-by-step way, using simple words, real-world examples, and clear connections between every part. This is your complete, powerful, deep-level understanding of the concept. The big question, what makes a country truly rich? Most people think, if a country has gold, oil, forests, or rich land, it must be rich. But that's not true. Many countries with lots of natural resources are still poor. Why? Because being rich doesn't come from just having things. It comes from what people do with those things. Step 1. Understanding resources. There are 2 main types of resources. 1. Natural resources. Things nature gives us, like land, soil, rivers, sunlight, rain, forests, oil, gold, minerals, wind. 2. Man-made resources. Things humans build or invent, like machines, factories, roads, tools, computers, electricity, irrigate, schools, laws, companies. Step 2 is having resources, wealth. Let's take 2 countries. Country A has a huge forest and rich soil, but no one is farming or making anything. The forest just stands there. Country B has poor soil and few trees, but people work hard, use tractors, grow vegetables, and run businesses. Which one will become richer over time? Why? Because the key is not the resources, it's how you use them. Step 3, the secret, flow of production. This is the big idea in the passage. A country becomes rich when there's a continuous flow of production. Let's break that down. What is production? Making or providing goods, like food, clothes, cars, or services, like teaching, healthcare, transport. What is a flow? A stream that keeps going, not once, but again and again, every day, every season. So a flow of production means people keep using energy, land, tools, and teamwork to create useful things regularly. And that's where real wealth comes from. Step 4. What creates this flow? This is the most important part of the passage. A country creates this flow when 1. People use their energy. They work hard, use their hands and brains. Example, a farmer wakes up early and works all day in his field. 2. They use natural resources, land for farming, forests for wood, oil for fuel. But the land alone doesn't grow food. People must plant and take care of it. 3. They use man-made tools and machines. Tractors, roads, internet, electricity work faster and better. 4. They work inside a social and technological system. There are rules, teamwork, schools teach skills, governments build roads, companies organize work. Example, a small village builds a cooperative farm where everyone helps and shares the crops. Step 5. What happens after production starts? 1. People earn income. They get paid for their work. A teacher teaches, a builder builds, a farmer sells food. 2. People collect wealth. They save money, buy land, build homes, start shops. Over time, this grows into bigger businesses and better lives. 3. Life improves for everyone. With more money in production, the country can build schools, hospitals, roads, clean water systems, internet. 4. People become happier and healthier. That's what economists call well-being. Let's compare 2 real-world examples. Example 1. Japan. Japan has very few natural resources, but people are highly educated, hardworking, and use smart machines. They make cars, Toyota, electronics, Sony, and sell them to the world. Japan is a rich country with high well-being. Example 2. Democratic Republic of Congo. Congo has tons of natural wealth, gold, diamonds, forests, but it has poor infrastructure, systems. People can't use resources to produce. Congo remains one of the poorest countries. Final deep summary in one paragraph. A country becomes rich not just by owning natural things, but by turning those things into useful goods and services again and again. That's called the flow of production. This happens when people work, use tools and machines, and organize their society smartly with rules, schools, teamwork, and technology. This creates income and wealth, which improves everyone's life. The real key to becoming a rich country is not what you have, but what you do with what you have, over and over, in a system that works. Would you like a diagram, a real-life village story, or a classroom-style quiz to review this too? Of course. Let's now go even deeper, step by step, in the simplest language, like I'm teaching a very curious beginner or a child. I'll explain every idea, connection, and hidden meaning behind the paragraph. We'll use easy words, real-life examples, and clear thinking. The main idea: how do goods and services flow in the economy? We are trying to understand, how does production happen in today's world? Who makes things? What happens to those things after they're made? How do they finally reach the people who use them? Step 1. Who makes things in the economy? In our modern economic setting, this flow of production arises out of production of commodities, goods and services by millions of enterprises large and small. Let's break it down. Modern economy. The way the world works today, where people buy, sell, work, use machines, and live in a system of money and trade. Flow of production. This means things are always being made, not just once, but every day, every year, by many people. Commodities. A fancy word that just means things you can sell, like goods, physical things, bread, phones, clothes, services, helpful actions, like teaching, cleaning, or cutting hair. Who makes these things? Enterprises, businesses, or people who make and sell stuff. There are millions of them. Big ones, like Tata, Apple, Infosys. Small ones, like a fruit seller, tailor, or mechanic. Example, a big car company makes cars. A chaiwala makes tea. Both are part of the economy. Step 2. All these things are made to be sold. But what happens to these commodities after being produced? Each producer of commodities intends to sell her output. Easy explanation. After something is made, what happens next? It is not kept or thrown away. It is meant to be sold. The person who made it, the producer, wants to earn money from it. Examples. A farmer grows wheat, wants to sell it to a mill. A woman makes candles at home. She wants to sell them at a shop. A taxi driver drives people. They pay him for the service. Everyone makes things or does things to sell them, not keep them. Step 3. All kinds of things are sold, from tiny to huge. From the smallest items like pins or buttons to the largest ones like aeroplanes, automobiles, giant machinery. Easy explanation. Size doesn't matter. Anything that's useful can be sold. Some things are tiny and cheap, a paperclip. Some are huge and expensive, an airplane. Example, a shop sells tiny erasers. Boeing sells big aircraft to airlines. All of these are part of the economic world. Step 4. Not just things. Even services are sold, or any saleable service like that of the doctor, the lawyer, or the financial consultant. Easy explanation. Services are things you cannot touch, useful and valuable. People pay for services like a lawyer helping with legal problems, a consultant giving money advice. They are selling skills and time, not products. Step 5. Who buys these goods and services? The goods and services produced are to be sold to the consumers. After something is made, it goes to a consumer, the person who buys and uses it. The consumer can be a person, like you buying a pencil, or a business, like a bakery buying flour. Step 6. Why are goods bought? 2 reasons. The consumer may, in turn, be an individual or an enterprise, and the good or service purchased might be for final use or for use in further production. 2 reasons people buy something. 1. Final use. Use it for yourself. Example, you buy, that's it, done. 2. Further production. Use it to make something else. Example, a tailor, the cloth becomes part of a new product. Step 7. Some goods change shape in the production process. When it is used in further production, it often loses its characteristic as that specific good and is transformed into another good. What does this mean? When you use something to make something else, it changes form. The original thing is no longer there. It becomes part of a new thing. Example, a farmer grows cotton. Cotton is sent to a spinning mill, becomes yarn, thread. Yarn goes to a textile mill, becomes cloth. Cloth goes to a factory, becomes a shirt. The shirt is sold in a store to you, final use. So the cotton changes many times. Cotton, yarn, cloth, shirt. Step 8. What is a final good? Such an item that is meant for final use and will not pass through any more stages of production or transformations is called a final good. Easy definition. A final good is the finished product. It's ready to be used, not for making anything else. Examples of final goods. A cold drink you buy and drink. A table you buy and use at home. A bus ticket you use to travel accent. Once you use it, that's it. No more changes. That's why it's called final. Summary in simple words. In today's world, millions of people and businesses make all kinds of goods, like phones, clothes, and services, like doctor visits, haircuts. These are all made to be sold, not kept. Some things are small, some are huge. Some are physical things, others are helpful actions. People or businesses buy these goods either to use directly, like eating food or wearing a shirt, or to make other things, like using cloth to sew clothes. When a product is fully finished and no more changes will happen to it, it is called a final good, like a shirt in a shop, or a cooked meal on your plate. Would you like a comic strip, a flowchart, or a real-life village story to go with this? Absolutely. Let's go even deeper and explain this in the simplest, like a teacher explaining to a beginner with zero knowledge. I'll also give you examples, break down difficult words, and add extra explanations to make everything super clear. Let's start from the main idea. We're trying to understand, what is a final good? What is a final good? A final good is a thing that is finished, ready to be used, and who will use it? Consumer. After this, the good will not be sold again to be used in making something else. Let's understand this step by step. 1. Why is it called final? The word final means the last. It is the last step in the economic process. Nothing more happens to this good in the business world. Example, you buy a shirt from a shop. The shirt is ready. You wear the shirt. You don't send it to a factory again. You don't sell it to someone else to make something new. This shirt is a final good. It has reached its final user, you. 2. What does it mean to pass out of the economic flow? Let's say there's a big river. That's the economic flow. Every time a business makes, buys, or sells something, that thing is in the river. But when you buy something to use for yourself, it's like that thing has left the river. It's not moving anymore in the economy. It's done. So we say it has passed out of the economic flow. 3. But wait, what if we change the good at home? You might think, but I do change it. I cook rice, I boil tea leaves, I paint my house. That's true. But here's the key idea. What you do at home is not counted as part of the economy. Why? Because the economy only counts things that are made or changed to sell to others. If you cook food at home, it's for yourself, not to sell. So even though the food changes, it's still a final good. Now 4. Let's look at a tea leaves example. You buy tea leaves from the shop. You boil water, add tea leaves, sugar, milk, and make tea. You drink it. Those tea leaves were sold to the final user, you, used at home, not used to make something for sale. So they are a final good, 5. Now let's look at the same tea leaves in a restaurant. A restaurant buys tea leaves. It makes tea. It sells the tea to customers. Now those tea leaves are not a final good. Why? Because they are used to make something else, tea. That thing is sold to others. The tea leaves were not the final thing. The tea was worthless. So in this case, the tea leaves are an input or intermediate good, not a final one. Mashup 6. So what really matters is how the good is used. This is very important. A thing is called a final good not because of what it is, but because of how it's used. Same item. Tea leaves at home equals final. Tea leaves in cafe? Let's introduce a new idea now. 2 types of final goods. Final goods. A. Consumption goods, consumer goods. These are things that people use and enjoy. Once used, they are finished. Examples. Food, clothes, toothpaste, soap, movie ticket, haircut, books. Even services like a haircut or watching a movie are also consumption goods because you enjoy them once and they're done. B. Capital goods. We'll explain these later since they come in the next paragraph of your book. Let's summarize everything. Question, simple answer. What is a final good? A good that is bought by the final user and will not be changed anymore by a business. Why is it called final? Because it is the last step. No more business or production will happen with it. If I cook or change it at home, does it still count as final? Yes, because it's not for business or sale. What if it is used in a restaurant or factory? Then it's not final. It's an input used to make another product. If something is a final good, it depends on how it is used, not what it is. What are consumption goods? Goods and services we use for our daily life. Food, clothes, fun, etc. Would you like a comic strip, flowchart, or a story with characters to help explain this too? Absolutely. Let's now go even deeper, but still keep it super simple and very clear. I'll explain everything like you're learning it for the very first time. Think of me as your best teacher, walking you through each part gently with easy words, real-life examples, and step-by-step logic. The big idea. When we talk about final goods, we're talking about things that are finished and ready to use. But even these final goods are not all the same. Some are meant to be used and enjoyed right away. Others are meant to help make other things. So final goods are of 2 types. 1, consumer goods, consumption goods. 2, capital goods. Let's now go very deep into each, very slowly and clearly. Chapter 1. What are consumer goods? Consumer goods are things people buy and use for themselves. They are not used to make other goods. They are used to enjoy, to eat, to wear, or to use real-life examples. Food. When you buy an apple and eat it, you are the consumer. The apple is a consumer good. Clothes. You buy a shirt to wear. That's a consumer good. Soap. You use it in the bathroom. It gets used up. It's a consumer good. TV show. Watching a show or going to the movies is a service. You enjoy it once. It's a consumption service, still part of consumer goods. Important point. Even services, like haircuts, doctor visits, or taxi rides are included in this group. They are not things you can hold in your hand, but you enjoy or use them directly. So, both physical things, like a sandwich, and non-physical services, like a massage, are part of consumer goods. 2. What are capital goods? Now, let's talk about capital goods. These are also final goods, but their purpose is different. They are not bought to enjoy or use directly like food or clothes. They are bought to help make other things. What does that mean? Think of a tractor. It helps grow crops, but no one eats the tractor. Sewing machine. It helps make clothes, but no one wears the sewing machine. Bakery oven. It helps bake bread, but no one eats the oven. These are all capital goods. They are used in production. They help make consumer goods. So, a loaf of bread is a consumer good. But the machine that baked it is a capital good. Capital goods are durable. These tools and machines don't get used up quickly, last for many months or years, help make many things again and again. That's why we say they are durable. Example, a bakery's oven can bake bread every day for many years. A builder's hammer can be used on hundreds of houses. But even though they are strong, get worn out. This is called down. Need to be repaired or replaced. So, we have to take care of them. Just like we take care of a bicycle, we oil the chain and fix the tires. Capital goods are part of capital. Now, here's an important idea. These tools and machines are part of something called capital. In economics, to make goods, we need 1. Land, place to grow or build things. 2. Labor, people to work. 3. Capital, machines, tools, and equipment. 4. Entrepreneurship, the person who plans and manages it all. So, capital goods are a key part of the system that helps us make things. If we don't have machines, factories, or tools, it's hard to make anything. That's why we say capital goods are the backbone, the strong support of production. What happens to capital goods over time? They don't last forever. Over time, a tractor gets old and may break down. A computer slows down and needs replacing. A factory machine may stop working well. So what do businesses do? They repair the machines, or replace them with new ones, or upgrade them to better ones. This process of fixing or replacing is called maintaining capital. When a country or company keeps its machines in good shape, it can keep making more and more goods. Final summary. Very simple. Final goods are goods that are ready to be used. Some final goods are consumer goods. We use them directly, like ice cream, clothes, movies. Some final goods are capital goods. We use them to help make other goods, like machines and tools. Capital goods are important for factories, farms, shops. They help keep production going. They don't last forever. They slowly get damaged, so we repair or replace them. Keeping capital goods in good condition helps a country keep growing. Would you like me to explain this with drawings or visuals, or explain the difference with a fun story or cartoon-style example? Yes, let's now go even deeper into this topic. In super simple, kid-friendly English, I'll break everything down line by line with clear logic, real-life examples, and extra details to help you fully understand the difference between consumer durables, non-durable consumer goods, capital goods, intermediate goods. Think of me like your favorite teacher using real-life stories, simple words, and smart tricks to make everything crystal clear. First, let's remember what a final good is. A final good is something that is completely finished, ready to be used, not going to be changed again in a factory. Example, a burger in your hand is a final good. You're going to eat it. Done. A car in a showroom is a final good, ready to drive. But wait, even final goods are of different types. Let's go step by step. 1. Consumer durables. What are they? Let's say you buy a television, car, laptop, washing machine, fridge. These are used directly by people, you, your family, last for many years, not used up quickly, can break down slowly and need repairs. These are called consumer durables. Why are they called consumer durables? Consumer, used by people for their personal needs. Durable, they last a long time and don't get used up quickly. They are different from food, used quickly, doesn't last. Soap gets used up in days. They are similar to capital goods in one way. They both are durable and can be used again and again. But capital goods are used to make more things. Consumer durables are used to enjoy or help people live their life better. Example, a fridge in your house, consumer durable. A fridge in a grocery store used to store products equals capital good. 2. Consumer goods, non-durable. Now think of things like milk, apple, toothpaste, bread, clothes. These are used by people like you and me, but they get used up quickly. Once used, they are gone. You eat the apple and it's finished. You don't repair or maintain them. These are called non-durable consumer goods. So now we have 2 types of consumer goods. 1, durable, TVs, cars, last long. 2, non-durable, food, soap, used up quickly. 3, capital goods. Let's say a farmer buys a tractor, a plow, or a builder buys a drill machine, a cement mixer, or a bakery buys a bread oven, a flour mixer. These are not used for fun or comfort. They are used to make other things. These are called capital goods. Easy rule. If something helps you produce other things, it's a capital good. If something is used by people directly, it's a consumer good. Even though capital goods last a long time, just like consumer durables, they are used in factories or farms to make stuff. 4. Intermediate goods, the raw stuff. These are things that are used during the making of something, are not final goods, are used up in the process. Examples: steel sheets used to make cars, flour used to make bread, wood used to make furniture, fabric used to make clothes, wires used to build electronics. You don't buy a steel sheet just to keep at home. You use it inside a factory to make something else. These are called intermediate goods. They are not final goods because they are not ready to use by people. Not capital goods because they get used up and don't last. They are raw materials or inputs. Let's put them all together, like a story. Imagine a cookie factory. 1. It buys flour and sugar. These are intermediate goods. They get used up to make cookies. 2. It uses an oven and mixers. These are capital goods. They help make cookies every day. They are durable and used for years. 3. It bakes cookies and sells them in stores. The cookies are non-durable consumer goods. People eat them quickly. 4. Someone buys a microwave for their home to warm cookies. That microwave is a consumer durable. It lasts for years and is used at home. Final super simple summary. Type of good used by lasts long, gets used up. Example. Example. TV, soap, toothpaste. Consumer durable, people, at home. Yes, no. TV, fridge, car, laptop, people at home. Yes. Food, soap, toothpaste. Capital goods, businesses. Yes, no. Tractor, factory machine, oven. Intermediate goods. No. Yes. Steel, flour, wood, copper wire. Would you like me to now make a new comic strip showing this full comparison in pictures? Or give you a quiz to test what you've learned? Absolutely. Let's go even deeper in the most simple, super clear way possible. Imagine I'm your favorite teacher and you're a curious beginner and we're sitting together with a whiteboard. I'll walk you through every single part of this step-by-step real-life stories, slow explanations, and extra clarity. What are we trying to do? We want to know how much total stuff is being made in our country. We call this total production or final output of the economy. To find this, we have to measure all the finished goods and services being produced. But we can't just randomly add things together. Problem. All goods are different. We can't say 5 tons of rice plus 10 meters of cloth, 2 cars equals 17 units. That doesn't make sense. They are different. One is weight, tons, length, meters. One is count, number of cars. You can't add them directly. It's like saying 1 banana plus 3 pillows plus 2 pens, 6 happiness? Nope. Makes no sense. Solution, use money as a measuring stick. So what do? We use money as a common measuring tool. Why? Because every product has a price, and all products are made to be sold. Now we can say, minus 5 tons of rice equals 10,000, minus 10 meters of cloth equals 2,000, minus 2 cars, 10,000. Now we add. Minus 10,000 plus 2,000 plus 10,000 equals 10,000, 12,000. That number is a total money value of all the goods made. Now we understand how much total final production happened. But wait, why only count final goods? Now you might ask, why are we counting only final goods? What about raw materials like flour, steel, or cotton? That's a great question. Let me explain. Let's imagine a simple story. A bakery. The bakery makes cakes. To make one cake, it uses flour, sugar, eggs. Let's say flour equals 50, sugar was 30, eggs 20. Cake sells for 200. Now here's the trick. The cost of flour, sugar, and eggs is already included in the 200 price of the cake. So if you count flour 50 plus sugar 30, eggs 20, cake 200 equals 300. That's wrong. You're double counting. You're counting the ingredients again, even though they're already inside the cake price. That's why we avoid double counting. We only count the final good, the cake. Its price includes the ingredients already. So, flour, sugar, eggs, intermediate goods, used inside the factory, not final goods. Cake, well, final good, ready to be sold and eaten. But intermediate goods are still important, right? Yes, flour, steel, wood, thread, all are crucial to production. Many workers make them. Many machines help produce them. But they are not counted separately in total production value because their value is already part of the final good. Counting them again would make the total look too big, which gives us a wrong picture. That mistake is called double counting, when you count the same value twice. Let's look at one more example. A car. Say a company makes a car. To make it, they use steel, 50,000, rubber, glass, 5,000. Final car is sold for 10,000. If we count steel, rubber, glass, and count the final car, we get 50,000 plus 10,000 plus 5,000 plus 10,000 equals 10,065,000. But that's wrong because the steel, rubber, and glass are already part of the car's cost. So the correct total is just 10 value of the final car. So what's the big picture? When economists want to know, how much did the country produce? They only count final goods and services, add their money value, ignore intermediate goods separately to avoid double counting. This gives us a clean, accurate number called Gross Domestic Product, GDP, total value of all final goods and services made in a country in a year. Final super simple summary table, type of good, used for, count it in final output. Why not? Kennel super simply in a country in a year. Intermediate goods, used to make other goods. No, already included in final goods value. Final goods sold to consumers or businesses. Yes. Final price includes all costs already covered. Would you like me to make a comic strip of this too? Or a fun quiz to test your understanding? Absolutely. Let's now go deeper, word by word, step by step, in the most beginner-friendly, zero confusion way, like I'm your favorite teacher sitting with you and drawing it out. Let's start with a real-life story. Imagine your friend says, I have money. You ask, how much? He says, there's 50,000. Now another friend says, I earn money. You ask, how much? She says, there's 10,000. Now here's the big question. One person has money. One person earns money. What's the difference? Here's the answer. First, flow. These are two different types of things. One, stock what you have at a moment, like Rs 50,000 in the bank today, 5 kilograms of rice in the kitchen now, 2 bikes in your garage right now. This is like taking a photo of something and seeing what's already there at that moment. So, stock is something measured at one point in time. It tells you how much is there now. 2, flow, what is happening over time, like Rs 10,000 salary every month, water coming from a tap each minute, a machine making 20 bottles per hour. This is like watching a video. You're seeing something move, change, or increase, decrease. So, flow is measured over a period of time. It tells you how much is coming in or going out over time. Let's make it even simpler with water. Imagine a big water tank. The water inside the tank right now equals stock. The water flowing in through a pipe per minute equals flow. So if you say the tank has 100 liters of water, that's stock. Water is flowing in at 10 liters per minute, that's flow. Why is this important in economics? Because in economics, we talk about how much a country has stock, how much it earns, produces, or spends over time, flow. Let's break down the original lines. At this stage, it is important to introduce the concepts of stocks and flows. We are learning the difference between two types of things in economics. Stocks, things you have, flows, things that happen over time. Often we hear statements like the average salary of someone is 10,000, or the output of the steel industry is so many tons or so many rupees in value. Examples of flow type things. Salary, 10,000 per month or year. Steel output, how much is made in a year. But these are incomplete statements because it is not clear whether the income which is being referred to is yearly or monthly or daily income. We must always mention the time period. Rs 10,000 per what? Per day? Per year? Without time, the sentence is meaningless. Sometimes, when the context is familiar, we assume that the time period is known and therefore do not mention it. If everyone knows its monthly salary, we don't say it. But technically, we should always say the time period. But inherent in all such statements is a definite period of time. Otherwise, such statements are meaningless. If we don't say the time, it's not a complete idea. All flows need time to make sense. Thus, income or output or profits are concepts that make sense only when a time period is specified. Income equals needs time, per month or year. Output equals needs time, how many products per day or per year. Profits equals needs time, profit in 1 month or 1 year. These are called flows because they occur in a period of time. Because they happen over time, we call them flows. Therefore, we need to delineate a time period to get a quantitative measure of these. Delineate just means mention clearly. To measure flows like income or output, we must clearly say the time, like per month or per year. Since a lot of accounting is done annually in an economy, many of these are expressed annually, like annual profits or production. Usually, we measure flows per year in economics. So we say annual income, yearly profits, total production this year. Flows are defined over a period of time. This is the final point. Flows equals happen over time. Always need a start and end time. Real life examples. Item, stock or flow. Why? Example. Rs 2,000 in your wallet. Stock. It's what you have now. I have 2,000 today. Rs 25,000 monthly salary. Flow. It's what you earn every month. I earn Rs 25,000 per month. 3 bikes in your garage. You own them now. I have 3 bikes at home. 5 liters of milk per day. It's coming every day. We get 5 Eller milk daily. 100 houses in a village? Stock. There are 100 houses today. New houses built in 2024. Flow. It's what was added in a time period. 20 new houses built this year. Would you like a comic strip version of this too? Like a tap and tank showing stock and flow? Absolutely. Let's now go deeper, word by word, step by step, in the most beginner-friendly, zero confusion way, like I'm your favorite teacher sitting with you and drawing it out. Let's start with a real-life story. Imagine your friend says, I have money. You ask, how much? He says, there's 50,000. Now another friend says, I earn money. You ask, how much? She says, there's 10,000. Now here's the big question. One person has money. One person earns money. What's the difference? Here's the answer. First, flow. These are two different types of things. One, stock what you have at a moment, like there's 50,000 in the bank today, 5 kilograms of rice in the kitchen now, 2 bikes in your garage right now. This is like taking a photo of something and seeing what's already there at that moment. So, stock is something measured at one point in time. It tells you, how much is there now? 2, flow, what is happening over time? Like, earns 10,000 salary every month, water coming from a tap each minute, a machine making 20 bottles per hour. This is like watching a video. You're seeing something move, change, or increase, decrease. So, flow is measured over a period of time. It tells you how much is coming in or going out over time. Let's make it even simpler with water. Imagine a big water tank. The water inside the tank right now equals stock. The water flowing in through a pipe per minute equals flow. So if you say the tank has 100 liters of water, that's stock. Water is flowing in at 10 liters per minute, that's flow. Why is this important in economics? Because in economics, we talk about how much a country has stock, how much it earns, produces, or spends over time, flow. Let's break down the original lines. At this stage, it is important to introduce the concepts of stocks and flows. We are learning the difference between two types of things in economics. Stocks, things you have, flows, things that happen over time. Often we hear statements like the average salary of someone is 10,000, or the output of the steel industry is so many tons or so many rupees in value. Examples of flow type things. Salary, 10,000 per month or year. Steel output, how much is made in a year. But these are incomplete statements because it is not clear whether the income which is being referred to is yearly or monthly or daily income. We must always mention the time period. There's 10,000 per what? Per day? Per year? Without time, the sentence is meaningless. Sometimes, when the context is familiar, we assume that the time period is known and therefore do not mention it. If everyone knows its monthly salary, we don't say it. But technically, we should always say the time period. But inherent in all such statements is a definite period of time. Otherwise, such statements are meaningless. If we don't say the time, it's not a complete idea. All flows need time to make sense. Thus, income or output or profits are concepts that make sense only when a time period is specified. Income equals needs time, per month or year. Output equals needs time, how many products per day or per year. Profits equals needs time, profit in 1 month or 1 year. These are called flows because they occur in a period of time. Because they happen over time, we call them flows. Therefore, we need to delineate a time period to get a quantitative measure of these. Delineate just means mention clearly. To measure flows like income or output, we must clearly say the time, like per month or per year. Since a lot of accounting is done annually in an economy, many of these are expressed annually, like annual profits or production. Usually, we measure flows per year in economics. So we say annual income, yearly profits, total production this year. Flows are defined over a period of time. This is the final point. Flows equals happen over time. Always need a start and end time. Real life examples. Item, stock or flow. Why? Example. Earth 2,000 in your wallet. Stock. It's what you have now. I have 2,000 today. Earth 25,000 monthly salary. Flow. It's what you earn every month. I earn Rs 25,000 per month. 3 bikes in your garage. You own them now. I have 3 bikes at home. 5 liters of milk per day. It's coming every day. We get 5 Eller milk daily. 100 houses in a village? Stop. There are 100 houses today. New houses built in 2024. Flow. It's what was added in a time period. 20 new houses built this year. Would you like a comic strip version of this too? Like a tap and tank showing stock and flow? Great. Let's now go even deeper and explain every idea again, word by word, like I'm teaching someone who has zero background in economics. I'll also add extra information, examples, and repeat things in different ways so you understand perfectly. We are learning 2 big things. 1, what is depreciation? 2, what does investment mean in economics? Part 1, what is depreciation? Let's go step by step. Step 1, imagine a new machine. Let's say a company buys a new machine. This machine helps make toys in a factory. The company pays $20,000 for the machine. Step 2. The machine gets old over time. The machine does not last forever. It may work well for 20 years, but slowly it will get used, damaged, or outdated. After 20 years, it will stop working. Then the company must buy a new one. So the machine is not good forever. It has a limited life. In this case, 20 years. Step 3. Every year, a small part of the machine is used up. Now imagine this. The machine is slowly losing value every year. Each year, it becomes a little less useful. Each year, a small part of it is used in production. So we don't say, it only loses value at the end of 20 years. Instead, we say, it loses a little value each year. Like a slow fade. Step 4. This yearly loss of value is called depreciation. So now we ask, how much value is lost each year? If the machine costs $20,000 and lasts 20 years, then depreciation equals 20,000 equals 1,000 per year. This means every year the machine loses 1,000 of value. This is called depreciation. Very simple definition. Depreciation means the yearly loss in value of a tool, machine, or building because it is being used and getting older. Another real-life example. You buy a new mobile phone for $20,000. It works well for 5 years, then stops working. Each year, it gets a little slower. Maybe the battery gets weaker, or new phones come out that are better. You don't lose $20,000 all at once. You lose $4,000 per year. 20,000 over 5 years. That's depreciation. Why is depreciation important in economics? Companies and governments must know how much their machines or buildings are worth now, how much value is used up this year, how much money they'll need to replace old machines later. It helps them plan better, count profits correctly, know what is truly new investment. Part 2. What is investment in economics? Now let's explain the word investment. This word has 2 meanings. Let's understand both. Meaning 1, everyday life, common use. People usually think investment means buying a house or apartment, buying gold, buying stocks, shares in a company, putting money into a bank account or insurance. They think, I'm putting money somewhere and I hope it grows. That is financial investment. This is what daily life. 2, economics, real capital investment. But in economics, the word investment means something different. In economics, investment means building or buying new capital goods, like machines, buildings, roads, tools that help produce more goods or services. This is called capital formation. Let's compare both, what people think, what economists mean. Buying shares, building machines, buying property, making roads, insurance policy, building a factory, saving in banks, buying a new tool. Economics example. If a factory builds a new building, buys 10 new machines, and makes a warehouse, that is investment. Why? Because those things will help the economy produce more in the future. They are called capital goods, things that help make other things. Back to our depreciation story. When we measure investment, we must think carefully. Imagine, a country builds 1,000 new machines this year, But 300 old machines broke down, got old, useless. That means gross investment equals all 1,000 machines made. Depreciation equals 300 machines lost. Net investment with 1,300 equals 700 machines added. So only 700 machines are truly extra this year. That's how we know if a country is really growing. Key ideas to remember. Super simple. 1. Depreciation equals yearly loss in value of machines' tools because they get old. 2. Depreciation per year equals total cost and no item lasts. 3. Economists' investment equals building new things that help produce more, like roads, factories, tools. 4. Gross investment equals all new capital goods made. 5. Net investment equals gross investment depreciation. 6. Net investment shows real growth in machines and buildings. Would you like a drawing or a comic strip showing this example with machines and depreciation year by year? I can make a simple cartoon to help you see it clearly.